Imagine you had a credit card and you just maxed it out. You got that warning. This is what we are dealing with the debt ceiling. I'm going to explain all of this today. My name is David Quintieri, and I have been looking into all of this financial wizardry for over a decade and then bringing you videos each and every single day. I take all that complicated stuff and I make it real easy. I am knee deep in the trenches hours and hours a day simply to bring this to you. You came here for the truth, so let me unveil that for you. In today's video, we're going to look at the debt ceiling. There are three aspects that we need to cover, three things, okay? And part of that is what's happening with interest rates. Then I want to show you how, by doing this, by what's happening right here and now, the international credibility of the United States and the dollar is actually being reduced. And then a third aspect here that I need to cover as well. The first thing though, you've got to understand, in January of this year, the United States hit a whopping $31.4 trillion in their debt limit. Your credit card is probably a little bit lower than that in terms of the limit, but hey, maybe you've got a Amex Black card without that limit. Anyway, you heard this right, okay? That's trillion with a T. That means the amount of debt that the US can hold has been maxed out. And right here we have Janet Yellen basically saying that the cash reserves could be drained by June 1st. June 1st. So we have a time limit happening right here and now. If that doesn't get your heart racing faster than your morning exercise, I really don't know what will, okay? Raising the debt ceiling isn't new, okay? Because since 1960, the United States has raised the debt ceiling 78 times. It's like a game of cat and mouse that they play, all right? This year, the debate is heated, as it always is. You've got the Republicans, the majority House leader calling for cuts in government spending. They won't do that. They never do. And on the other hand, you have the president basically saying that the increase in the debt ceiling should happen with no strings attached. It's like deciding on whether you're going to pay off your credit card bill now or buy that shiny new gadget that you've been looking at, all right? To add to the mix, the sharp uptick in interest rates is reminding us that our debt levels could become a slippery slope because a little bit of addition in that debt makes a big difference when your interest rates are higher. This is just something that I can show you with the probability of US recession right now at 68%. 68%. And you go back, I mean, just compare this, by the way, in this one metric. This is just looking at the Treasury spreads. This is the way, I mean, there's many ways to do this, but with Treasury spreads. Looking at it going 2020, looking at this in the financial crisis, the dot-com, we are higher now than we were back then. And so there's a lot to this, of course, when you look at the yield curves as it inverts. What does that mean? The whole thing, I've explained it before, but essentially imagine you're buying debt. You're going to buy a 30-year bond. You would think that 30-year bond would give you a better return than that, let's just say 1 year. But it's actually the reverse, okay? Yield curve inversion. But when it comes back up the other way, that's when we tend to have a recession. And right now, essentially, we are right in the middle of this occurring, okay? The cost of servicing the debt has been on the rise. It's almost on par with the United States defense budget. So imagine that, other than the black budgets and all that, where you have the same amount of money being spent, and you know how much they spend on murder, but at the same time, they're spending the same thing on the debt. Crazy. Imagine that. You know, the United States is spending practically as much on the debt as they are going around dropping things from 30,000 feet up in the sky. You know, it's like spending as much on your credit card that you do on your rent. Like think about that for a second, okay? It's not a fun place to be. Now, you got to understand here, governments around the world, not just the US, raise their debt ceiling as a way to finance their operations. It depends on the country. Some don't do it like this. Some don't actually have debt ceilings. But when you think about this, it's really disingenuous because you know they're going to spend more. They are not ever going to cut spending. And so during these periods of time, this difficulty of back and forth and concern, oh no, what are we going to do? Credit default swaps right here and now are at a level which we haven't seen in a very long time for the United States. And it's crazy. I want to show you it. US credit risk looks like an emerging market. Just compare the two. You're seeing that black line, right? It's up and up and up. Okay, that's the United States. This is for a credit default swap. Unbelievable that Mexico, Greece, and Brazil are far lower than the United States. It means, essentially, that the US has more risk of default than these other emerging markets. Now, I'm not so sure about that, but at least the talk, the rhetoric is there. You let me know what you think. Okay? Here we have this. I think it's important to understand, you know, we can look at this, we could see what it shows us, but let me just cover the next point. You know, when you could see that for a lot of people, they don't realize what this is all about. But let me explain it in depth, okay? The debt ceiling. Just look at what has happened in previous instances. The debt limit was suspended for long periods between 2013 and 2020. Congress has suspended the debt limit 7 times since 2013. So the expectation is that they will do it again. But several years ago, I believe it was 2010, 2011, the S&P downgraded the government's credit rating from AAA to AA plus. And they have confusing things because all the different rating agencies do it a little differently. Anyway, the point is they downgraded their rating. The financial crisis led to a significant increase in government debt. So we can see all of these things have added up. And we know that it isn't a good sign when your debt to GDP ratio is at 129%. Some would argue that over 100% is basically it's done. Finito, it's done. But nobody really knows. The idea here is that eventually the United States would monetize the debt directly. Right now they do that indirectly. So they have an intermediary. They have somebody like a JP Morgan that will buy it up, and then the Federal Reserve comes back around and buys that off of them. So it's indirectly. But what's happening right now is a lot of this debt is sitting there in a big pile. Eventually the Federal Reserve will buy that up, monetize, and devalue the currency. And this is something that is very, very frightening to the average person. This is what the debt ceiling is all about. I don't want to just go on and on. I think you get the point. I think you see where we were historically in the different instances. And that's what this really is. I expect them to eventually, maybe it's a period of time, maybe there is a little bit of back and forth. Oh no, we don't like each other, World Wrestling Federation nonsense. But eventually they're going to come to terms. More money will be spent. And unfortunately, you and I, we don't ever see the benefits of that. The average person, the middle class, doesn't see the benefit. That's just the way it goes. What do you think about the debt ceiling? I really want to know what you think, because in the polls that I've done with you guys, everybody believes that they're going to increase the debt ceiling, they're going to spend more money, and that's just the way it goes. I want to know what you think. Let me know in the comments below, and I'll see you tomorrow. Take care.